All right, guys, if you're, we're just getting set up here, getting started. If you're watching this after live, you can advance forward on the video. We have Phil Simonetta coming in with us here today, and maybe a couple others. We might have John Hoffman log on, and Amy Nixon. We'll see. I was talking with them earlier, and we'll see if they can come on. Today is a big Fed announcement. We're waiting, actually, right now at 2 o'clock. The Fed's going to announce the interest rate, whether their decision, the interest rate decision, whether they decided to cut another quarter of a point or more, or whether whether they'll do nothing or raise the rates. Of course, the markets are going crazy today. They're sort of baking in, I guess, the fact that we will get a rate cut today. And we're going to talk about what kind of effect that will have on the mortgage rates. So as we're waiting for the Fed announcement here, the last time that they cut rates, well, they've cut them 2 times really in the last year. They cut rates on November 7th by 25 basis points to a target range of 4.5 to 4.75. Or I'm sorry, yeah, sorry. Thank you so much, Joe. No, September 17th was the last cut. It wasn't, the November was when they started to cut the rates, November 7th of 24. And a lot of people think that the Fed rate has everything to do with mortgage rates, and it doesn't. It's the overnight trading rate, and that is what the Fed sets. The Fed wants banks to borrow money from each other. And the Fed really is supposed to be a sort of like a bank, if you will, of last resort. So the Fed will lend money as well, but the Fed sort of mandates the rate, the trading rate that banks borrow from each other. And that really affects like commercial loans, credit card rates, auto loans, not mortgage rates. Mortgage rates are really set by the 10-year Treasury. And interestingly enough, back in November when they cut rates, mortgage rates actually went up. And then most recently in September, they cut another 25 basis points, bringing the Fed target range to 4% to 4.25%, that bank trading rate where they borrow money from each other. Again, what happened when they cut rates in September, we watched mortgage rates go up. Now, mortgage rates have definitely come down. And in fact, I know someone that just got a 5.99 FHA rate. So rates are definitely going down, but we haven't really seen that impact the housing market. And as I've said before in previous podcasts, the builders have been buying down rates for several years now. And we haven't really seen that change much in the housing market. It certainly hasn't encouraged sellers to get off the shelf and start to sell their houses. They're locked in at those 2 and 3 handles, a lot of them. And, but then you have a whole cohort of homeowners that probably would like to move and they don't even have a mortgage at all. But the fact is they're faced with the high home prices. So if they sell their house, where do they go? They would actually, in many cases, even if they have a mortgage, they would be paying more for the house and getting less house. So the housing market is kind of frozen. And we do have home buyers that have said, you know what, I have to buy anyway. I'm just going to buy. And then if rates do come down significantly, then I'll just refinance and I can afford the payment now and I'll just take the savings. But we still have that issue with homes sitting on the market for a lot longer than they have in many years. And we're seeing prices come down. which is, a welcome change for a lot of home buyers, but they're not seeing that inventory. That's the problem. So the houses on the market, they're sitting, their home prices are coming down, the sellers are cutting. Some of them are cutting by very small amounts, $1, $1,000. It's not really doing anything except recirculating those listings back through anyone that has a search saved. So a lot of people are looking at it and they're going, oh, wait a minute, I saw that house before. And so it's not really doing a whole lot. So houses are just sitting. And then we see a lot of houses that are just being delisted. Joe, it's 2, so let's just keep an eye on that rate announcement. The Fed is going to announce right now what the rate change will be, if any. But more importantly, we're going to tune in at 2:30 and sort of listen together to what they say about the state of the economy, what they're putting out there, because consumer confidence seems to be very low. And we're also going to pull up and talk about some of these layoffs. Amazon just announced yesterday. I have an article we'll show you here on CNBC where they plan to lay off possibly up to 30,000 people, but 14,000 is what they put out there, which is significant. That's a big shock to a lot of people. But confidence is sort of dropping, and what I'm hearing a lot from home buyers is they're saying, you know what, I'm just uncertain. I'm just unsure of whether I should buy anything right now because they're watching friends get laid off. AI, I think, is having a bigger impact already than we expected. I always expected it to be a big disruptor, but I think the pace that's moving, a lot of people are unsure whether their job will even be around. And we're talking about industries that you wouldn't even think of. I've heard people that have said that if your job was replaced by AI, you didn't really have a job. I mean, that's kind of crazy to put out there. But I think even attorneys, their jobs are at risk because you can find just about every contract on the internet if you're trying to do something. So I think they'll be impacted significantly. So we're going to listen to the actual press conference and hear what these major news sources ask Jay Powell and see what we can extract out of that to sort of feel, what's going on. Okay. All right. Okay. You're going to make me put my glasses on for that. So anyway, like I said, if you're watching this after we're live here and you want to advance through, certainly feel free to do that. So Fed cuts target range for benchmark rate by 25 basis points. So there you go. That's the announcement. Like I said, they put that out there at 2 o'clock and then address the press at 2:30. But let's bring Phil in. Is Phil on? Hey, there he is. Phil Simonetta.
Hey, Todd, what's going on, man?
What's happening? This is Phil. He's a friend of mine. If you've watched our channel before, you haven't subscribed to our channel, please consider doing so now. You'll know when we upload content. But Phil is a mortgage guy now. He just was licensed to originate loans, but he is a real estate broker. So, fellow broker, what's going on?
Not too much, man. How's everything going over there?
We're just watching the markets, watching everything happen. It seems like markets were going crazy earlier. Everybody wants rates to come down. And I'm not saying, look, it's one of those things that we both know, and I think everybody knows, that the Fed buying mortgage-backed securities has really incentivized home prices to rise. And I've never seen home prices rise like they have since they suppressed rates down to 2.75%. And what happens when the housing market starts to stall because it's such a big part of GDP, it really throws a wrench in the whole system. So when home prices decline, we have a lot of problems. We have people that turn their keys back in when the house next door is $100,000 less than their house. They kind of give up, and a lot of people gave up back in the 09, 2010. A lot of people turned their keys back in, and they could afford to pay their mortgage. They just chose not to because they're like, why? And so when the rates are suppressed, they kind of try and stop that falling home price. I mean, they want to stimulate the economy, obviously. However, what happens is that may be the only tool in their toolbox, the Fed.
Yep.
But that doesn't necessarily stop the damage that's been done to the economy, where inflation ran so high that just about everything is so unaffordable. Rent, groceries.
I think they played their last card, man, because if you look at the last cuts where the mortgage rates actually went up and it didn't really affect them. See, in the past, they had the card to play. But the problem is now, because we talked about this before, when they lowered the interest rates so low, the consumer can afford a payment, right? So we talked about how they go for that payment, X amount of dollars a month. Well, when they lowered those rates significantly to 2.5, 2.8, 3.25, that payment that they could afford allowed them to buy much more house. The problem is reality set in, rates came back up, and the people can still only afford a certain payment. Now that payment buys a lot less house, and the people who got in those houses at those high prices afforded the payment. Now the people buying today cannot afford the payments to keep that, to sustain that value. So those values need to come down so the public can afford those payments. And the only way that happens is prices returning to the levels they were at the rates they were at prior to the falsification of the rates coming down. And that's kind of, nobody looks at the logic of it, but that's what it comes down to at the end of the day. It's black and white.
I mean, it's hard to believe that people don't look at the logic. I think they don't look at the logic, but I think consumers.
That's what I'm saying. They don't look at it. Right.
Yeah.
Consumers feel it. It's fact. Yeah.
And a lot of the consumers that did bite at the higher price, the overpriced house, because they were paying more for the house than the appraised value, and that's why they had appraisal gap addendums where they had to pay the difference from the appraisal and the purchase price. But what you're saying is so true. They are actually consumers, because they buy payments. I think that is also one of the what will really rock the real estate sales industry moving forward. Because a lot now we're seeing where sellers aren't offering any buyer agent compensation, and that is not a financed line item. They can't. And I think one of the reasons why consumers were less, they were less concerned about the commission that was wrapped into the deal, because a lot of people say, well, the commission's in the price of the house. I mean, the seller knows what they want to net, and they're hoping that they can sell it for a price where they can, after they pay the agent's commissions, that they will eventually, they'll end up with a number that they are happy with. So in a lot of ways, buyers didn't think about commission so much because it was financed in the deal. And now that we're seeing where sellers are saying to their listing agent, I don't want to offer a commission to somebody that's competing with me, against me, a buyer, they don't share the same, they want the house, but they're like, why am I paying for a buyer's agent when that buyer's agent is actually negotiating against me? So we're finding a lot of sellers now, since the NAR lawsuit, are sort of, now that they're privy to, they should have been privy to it before, because real estate commissions have always been negotiable. However, now they're saying, I don't want to pay it. And the only way then, with a buyer signing a contract with a buyer agent that they can buy that house that's not offering it, is they have to ask for it, or they have to come out of pocket and pay their buyer agent directly. And as well as I do, They don't have the cash.
They don't, and that's a big problem too. I mean, it's a lot of the buyers right now are strapped, and I mean, there's nowhere for them to turn to pull the money to get into the homes. So they're strapped. They only have so much to get in. You know, the taxes, the insurance. You know, I'm working with buyers right now, and I mean, there was a CDD fee. It blew it out of the water for them for a development. You know, and it's just they're getting hit at every corner. Like the buyers, there's no reasonable deals. It seems like there's always these add-ons and these tack-ons, and just to get into the house. It's like they're taking everything they have just to get into the house. You know, something happens, they're in trouble. I mean, the reserves aren't there. They have nowhere to turn. And a lot of them, they're ending up being house rich and pocket poor. And the problem is, I don't advise them to do that. That's a bad investment, you know, to get into something where you take all your savings and you're strapping yourself out of, you know, 55% of your debt ratio into a house. Cause that's what it's coming down to. I mean, you have, you know, two people working, you know, making $150,000 a year. You know, you used to be able to afford a house and enjoy your life and go out a couple nights a week and, you know, take your kids to go places and things. And now it's like they buy a house and they're stuck in it, you know, and that's the dilemma a lot of people are facing right now.
I was in a house yesterday. We have a radon. You know, you probably deal a little less with radon in Florida, though it's been said that 1 in 5 houses in Florida still have radon. Maybe not right on the beach, but
right.
But anyway, I was in a house, and the house is it's less than 10 years old, and it was sold and it was vacant. So it's kind of a nice house. It's a newer house with poured foundation walls. And so we recorded this video yesterday, and when I was walking through, I said, you know, whoever lived in this house, whoever bought it, they didn't do anything. And you know, when you buy a new house, a lot of times the builder will not build a deck. They'll put a safety gate across something that's attached to get the use and occupancy. Sure. You can't open up the door and fall, you know, 3 feet or 4 feet. So they'll put like a picket safety fence in place, something that's screwed in.
Yeah.
And that was still there. The only way to get to the backyard in this house was you couldn't use the side door, which was towards the back of the house, to have envision like a walkway. And then in the back, somebody would have a nice deck. So the safety gate was still up. The only way to get into the backyard was to walk through the house, out the front door, and all the way around to the backyard. And the basement was still unfinished. And the house looked worn. I mean, it wasn't horrible, but it was definitely worn. It needs new paint. It needs some updating. And this is common that, you know, even before home prices skyrocketed, a lot of people, they overstretch to get in a house, and then they have no money to do any of the updates or upgrades. And,
right.
You know, and even going into listings, when you're going in a house to sell, you walk in there and you see living rooms or dining rooms with no furniture, and you know, and I'll say, you know, hey, have you already started? Yeah. Have you already started packing? And do you have your furniture in storage? See, these rooms are empty, and they'll say, no, we've been here 10 years and we've never had furniture in those areas.
Right.
So just keeping up with the Joneses, you know, just. Yeah. Phil, when talking about back in the 2008 crisis, the Fed dropped rates to nearly zero. And now, you know, with that Fed funds rate being another 25 basis points, so right around 4%, 3.75 to 4% is the target range. That's still a lot higher than they dropped the rates back in the 2008 crisis. 2009, 2010, it didn't do anything. It didn't save the housing market. Now, we're not in that same position as we were back then yet. I say yet because it's still quite possible, I believe, especially since FHA stopped.
Yeah, but I think people in general are in worse financial shape with debt, student loans, credit card debt, auto debt, which they're paying, you know, $500, $600, $700, $800 payments for cars and car insurance, homeowners insurance. I think consumers are in worse shape now financially the whole picture than they were back then,
I want to, as I'd mentioned earlier when we started going live here, I said that the Fed rate really doesn't change the mortgage rates. It really is. It has been in the past, the Federal Reserve buying mortgage-backed securities. I want to pull a chart up here, and this is a chart that I created to illustrate some of what has happened historically. But I want to focus on the timeline. That top line, the blue line, are new home prices over time, going way back to 1963. And you can see in 71, we went off the gold standard. And that's really what I was illustrating in this chart, is that median incomes, and back in the 60s, and even before that, there were a lot of times there was only one income working in the house. And now we have two, and we have more than two incomes in a lot of cases, because people are doing things like driving Uber and Uber Eats, and they have a side gig. And sometimes now we even see where mom and dad are in the house, and they have their Social Security check that's helping to pay the bills. But really, in 1971, we went off the gold standard. We really started to see asset prices, home prices rise. But over time, home prices always go up, and typically they adjust for inflation. The middle line there, the orange line, is really if you compound year-over-year home price appreciation. That was really meant to keep up with inflation. And so what I did with that orange line is I was really illustrating if we had a 4% year-over-year home price appreciation. You can see we have much more than that over time. But that's really what we saw prior to 1971, is we saw the home prices appreciated anywhere from 3 to 5% annually to keep up with inflation. And then jobs, you would get that 3% or 5% annual rate or annual salary increase for inflation. A lot of companies would do that.
Yeah, sure.
And so basically what happens is we follow this along. Home prices never really dropped until we get up to, really, I don't know what, when you look here, right around that 2008 mark, we saw home prices decline. And then what happened was, as the Fed's response, the Federal Reserve, for the first time ever, bought $1.25 trillion of agency mortgage-backed securities. And that started on January 5th of 2009. And what that did, you can see here, instantly, it stopped home prices from declining.
Yeah.
Because if they are buying mortgage-backed securities, they can predicate the rate, where investors might say, I don't want to do a 30-year mortgage. I don't want to invest that, in a 30-year fixed rate mortgage for a 4% return on my money. But the Fed said, well, we'll buy them, and by that, they could drop the rate. And it instantly impacted home prices. So you see in this chart, home prices then started to go up. And then what happened in 2019, we saw for the second time historically since post-World War II, we watched home prices start to dip. In 2019, we were actually going into a recession, and home prices were declining. Only second time in this chart that you can see that. And what happened was the Fed started to buy mortgage-backed securities again. And, because we had obviously 2020 hit, and they started to do it again. And then you can see the straight up line with home prices during that 2021, 22, and 23. And then prices are again falling. And so we're kind of expecting, what's the Fed going to do, or what is somebody going to do about this? And I want to pull up something, because this has not been publicized very much, but I found this article on, we can pull it up here too. I found this article that was published by communitylender.org. And Joe, can you pull that up? Yep. Okay. And so basically, this was a little over a week ago. Well, it's actually on Scotsman's Guide. Sorry. There's a couple that posted, but the Scotsman's Guide is where I found this. It says community lender groups pitch plan to Bessent and Pulte to lower mortgage rates. And what they're saying here, the last time the 30-year fixed rate mortgage had a weekly average below 6% was in September of 2022, according to Freddie Mac data. During the ensuing 3 years, the 30-year rate averaged 6.73%, reaching as high as 7.79% in October 23 and as low as 6.8% during September 24. So a pair of mortgage trade groups have proposed a plan they believe will help lower those stubbornly high rates by addressing the secular and structural decline in demand for mortgage-backed securities. So people don't want to buy them. It's risky. So in a letter addressed to Treasury Secretary Scott Bessent and Federal Housing Finance Agency, FHFA, Director Bill Pulte, the Community Home Lenders of America, CHLA, and the Independent Community Bankers of America, ICBA, laid out steps they think could reduce mortgage rates by 30 basis points or more by narrowing the spread between the 30-year mortgage rates and the 10-year Treasury yields, also known as the 30-10 spread. So what I did was I looked this.
The question, Todd, the question is, who's buying them, though? The only people buying, no one buying them.
Hang on. We're getting to that.
Yeah.
So let's pull up the letter. This is interesting stuff here. So this is the letter that these two groups wrote to Scott Bessent and Director Pulte. And it says, we write to propose a solution that will reduce the historically high long-term mortgage rates relative to long-term Treasury bonds. Housing accounts for nearly 20%. Housing accounts for nearly 20% of GDP and affects all homeowners and renters, especially those in underserved and rural communities. Action is critical to address homeownership affordability and lending challenges and reduce impediments for servicers to loss mitigation efforts to keep defaulted borrowers in their home. And it says specifically,
so they want defaults. They want to stop the defaults.
What they want to do is they want to buy $300 billion of their own mortgage-backed securities. So that's the basis of this letter. And
so they're bailing themselves out, basically.
Well, they're under conservatorship of the federal government, so they took them over in 2009. I know President Trump has been talking about privatizing Fannie and Freddie. Yeah. But still, the proposal to do that, from what I understand, is that the government will still insure the mortgage-backed securities, even though they're a privatized entity writing these or guaranteeing these mortgages. Which, by the way, Fannie Mae and Freddie Mac are conventional backers, conventional mortgage backers. Right. The FHA is still the government, and same with VA and USDA. Mm-hmm. So what do you think about this? What are your thoughts on them buying $300 billion of mortgage-backed securities? On average, I figured it would be about 1 million loans that they could buy.
What funds are they using to buy? Are they going to print the money? I mean, there's no investors. There's no hedge fund. There's no countries investing in our bonds now. Who are they going to package them up as bonds and try to sell? Who's buying it? That's the question. They're asking them to print the money to buy it, right? That's what this letter is asking? Have the government buy them?
Unless you think, well, I guess it would pass through Fannie and Freddie, but unless you think they're going
to create the money.
Unless you think they have $300 billion sitting in an account somewhere, maybe they do.
Right. No. So the minute they do that, they're going to kill the dollar and get ready for $15 gas. They can't just please buy these and print the money. It's like playing Monopoly. They don't understand how this is going to affect the market when this trickles down through the market and to the average people. You can't just take $300 million and buy people's mortgage-backed securities out because they made bad investments. they need to fail.
Well, the question is it a way that you don't say, well, the Fed didn't directly buy mortgage-backed securities, Fannie and Freddie did. So because I
But it's
think
still coming from the same
Powell
money.
had mentioned, and that's a type of what's called quantitative easing, right? When you
Well,
create
sure, they're
money,
bringing it, yeah.
when you create money to buy mortgage or securities of any type, whether they're bonds or what have you, their own bonds, the federal bonds, or whether you're buying mortgage-backed securities that the federal government is, standing behind, backing.
Yeah.
Regardless, the money's got to come from somewhere. But the question is, what would that do? If it was 30 basis points, that would be about 0.3%.
Yeah, so you're down to 5 3/4 or 5.8, 5 5.8 on a mortgage. It's not going to do anything.
Yeah, I'm with you. I don't think it will. I don't think it's going to do anything. I think it will help. I mean, look, don't get me wrong. If you're a home buyer and you can get 5.5% versus 6.5% or 7%, that's a big deal. If you're financing a $500,000 house, if you're financing $500,000, a point is $5,000 a year. It's almost $500 a month.
Right.
So you're talking about.
Right, but here's the thing, Todd. Yeah.
But
here's the thing: are the people going to? It's going to affect the pricing again, right? So when the people save the $500 a month, it's not like they're going to save the $500 a month. They're just going to get the house a little more expensive. It's going to.
I don't think it will.
Prices falsely inflated. You don't think so?
I don't think it will. It didn't.
You think people this time will say, "Okay, I'll lower the price"?
Yeah, I don't think the difference in the house price makes that much of a difference between 6.5% and 5.5%. I think that buyers now want. What they want is they want a cheaper rate and they want a cheaper priced house. They want the sellers to come down.
Right.
I mean, the prices are crazy. I mean, I can't believe
it's insane.
It's insane.
I know. I can't believe it either. How's it? I mean, what they've gone. It's crazy. I know.
We've got about 3 minutes. Let's just pull up on the side here, Joe, so that we know when the Fed is when Jay Powell is coming out. But we've got about 2 minutes now till that happens, and then we're going to cut over to that and talk about, listen to what he has to say, and then talk about it as it's happening. One of the things that I've said that the only thread that has really held the housing market up and prevented it from really crashing is the fact that the job market has been relatively strong. And then over the last 12 months, we've seen a lot of shakeup in that. Amazon just announced 14,000. Yeah, corporate jobs. These are corporate jobs, not assembly line workers, not people folding boxes.
Not the drivers.
These are not the drivers. These are corporate jobs. These are white collar jobs where people are probably making a lot of money. And one of the reasons is preparing for this AI. They want to rely on AI. And, we can pull up. There's a CNBC article that posted yesterday. And Joe, just interrupt whenever it comes on. But the CNBC article that was published, Amazon's laying off 14,000 corporate workers as it invests more in AI. This is scary stuff. Amazon, the company said it's cutting roles to help make the company leaner and less bureaucratic. Come on. While it looks to invest in generative artificial intelligence. The layoffs are expected to ultimately be the largest corporate job cuts in Amazon's history. Probably some of the biggest layoffs that we've seen in any company's history. Usually,
it looks like Jeff Bezos took a example from Elon Musk when he got rid of all the people at Twitter. So he's getting rid of half the staff, and he's still going to do the same job.
We got him. He's not out yet. Okay. All right. Here we go. All right.
Sounds like here we go. Here he comes.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point. We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up.
Amazing.
In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal.
He says that every year.
Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3 3/4 to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent.
He says that
and
it's
that
crazy.
is a risk to be assessed and managed. Our obligation is to ensure
Just not
that a
reality,
one-time
man.
increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long-stated plan has been to stop balance sheet runoff when reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet, and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition of our balance sheet. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to...
Well, for whatever reason, I mean, he is holding strong to the political pressures because I know the administration would like to see him drop them 3 percentage points.
With how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that needs to be taken on board. We had, I would just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have, strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have, how that affects the outlook and the balance of risks. And I'll just say that.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, other people would say moderately restrictive level, needed to move more in the direction
You always get it wrong.
over time of neutral. If the two
it's always
goals are
worse
sort
than they
of
thought.
equally at risk, then you ought to be at neutral, because one of them's calling for you to hike and one of them's calling for you to cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
They don't want deflation, which is what we need.
Claire Jones,
Correct.
Financial Times.
They've been
Thank you for
stopping it for
taking this
years.
question. We've just heard.
It's got to
from you
stop
that
eventually, though. It's got to hit a wall.
The discussion
sooner or
in
later.
December, and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any consideration, for instance, of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
You know, I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. You know, I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And, you know, some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when more participants go out and talk, they're very disparate views, and they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, you know, that we haven't made a decision about December. You know, I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
You know, that could be one of the factors, but the reality is we've seen, you know, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, you know, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, you know, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars, because, you know, again, with the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, you know, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, you know, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby.
Thank you. Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, you know, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second-round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, you know, that would certainly play into our decisions going forward. So, we do have, you know, we get some data. The labor market is a place where we get, for example, we get the state level data on initial claims, which are sending a sort of a signal of more of the same. We also get, you know, job openings. And we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market. And, you know, the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if the shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So, we get, like I mentioned, what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the beige book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or material change in the economy one way or another, I think we'd pick that up through this.
He thinks.
So in terms of how it might affect December, it's really hard to say. December's, the meeting's like 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
He thinks he's going to get the data. Welcome, Amy Nixon.
Hi.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had two dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool.
Amazon
And
just
again,
cut
people have
14,000
different- they have
jobs.
different forecasts and expectations about the economy and
Yeah,
different,
one company.
gradually going.
risk tolerances. And so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop at the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
That's
So
the
you're right.
question.
The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in treasury bills, which will foster both a more treasury balance sheet and also a shorter duration. So that's what, in the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing that has to be ample. So that'll happen for a time, but not a tremendously long time. We don't know exactly how long. But at a certain point,
So that
you'll
opens
wanna
up the
start
door for
Fannie
Fannie and Freddie to buy the 300 billion from
to keep
the
up
backed
with,
securities from
the
Pulte
size of the
they wanna
banking
do.
system and the size of the
Billion,
economy. So we'll
billion.
be adding reserves at a certain
300 billion.
and that's the
300
last
billion,
point.
yeah.
Even then,
That opens the door,
We didn't make
since he's
decisions
not-
about
he's
this
freezing
today,
it,
but
yeah.
we did talk
Purchasing.
today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities. And we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So, okay, so the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation, but we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments, but so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news, that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we'll expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services. And we don't take a lot of signal about the tightness of the economy from that. We've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that? And especially when we're seeing potentially labor supply challenges?
Raise rates.
Sorry, say that first.
The stubborn services inflation that you mentioned.
Service inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just, we think policy is still modestly restrictive in my telling. So that's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market is because the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer term,
they're just going to fuel AI even
pricing,
more because the
you will see
companies
that-
are going to
that-
make
that's a
job
credible
cuts
commitment,
to keep their
and
profit
there should be
margins
no
higher.
question that that's
AI is
where
going to
we're
take a
going.
lot of jobs.
Chris.
Yeah, the labor cost is the biggest.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all. And could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles? How is the Fed thinking about that?
So I don't think that you're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
And then just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but you know all of these. I'll just mention some of the many names: Price Stats, Adobe, and others. For wage inflation, there's ADP data. On spending, you're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard?
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about a continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys or the Beige Book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it, and that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up in the debate in this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully. And yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are. If you listen to the earnings calls or the reports of, big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are spending at the higher income and wealth, and so much anecdotal data on that, and so we think there's something there.
Edward.
So,
Thank you. Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So in December, he said, far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then?
Well, the perspectives of people on the committee that, we've now moved 150 basis points and that we're down into, you're into that range between 3 and 4 where
And it
most
did nothing.
many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether, in fact, the growth, that the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last 2 meetings, and there's a sense like, from some, let's pause here, kind of thing, and a sense from others wanting to go ahead. But that's why I say differing views, strongly differing views.
Yeah, so on that division, then you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have, in fact, cut 2 more times. And, we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes. And
It's like they're always on
that's what happened
defense.
in
They
the
never want to take an offensive position and do something. They want to react. They don't want
Thank you
to.
so
They don't
much.
want to
Liz
take
Scholze
anything on.
with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are 2 things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's 2 things. That's declining labor force participation, which is a cyclical thing, and then there's declining.
So we get rid of the
immigration, which is
people
just a big policy
because
change
we
that
can't
actually
get
began
people.
in the last administration, and it has been accelerated now.
Right.
So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and the unemployment rate has gone down, meaning that demand for workers is going down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand, and I would just say, when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to 0. So maximum employment doesn't, on a sustainable basis, if you're creating 0 jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last 2 meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that.
OMC
We've
cut a
reduced
quarter
so
of a
that
point
rates
if you're
are
just
looser.
logging
I
on.
wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. So it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools. but others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory, this is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level. And then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that, that prices are not going up as fast as they were, but they're still much higher than they were. And it'll take some time for that effect to wear off. As real incomes rise, it will feel better over time, but that's going to take time.
All the tariff stuff is hypothetical. They're supposed to be data dependent.
Bloomberg Television Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
They keep going back to the tariffs just to keep jabbing at it, trying to keep it in the talking points
and say, hey, that's wrong. It's not our job to do that. We look at the overall financial system, and we ask whether it's stable and whether it could withstand shocks, right? So, banks are well capitalized.
It's like they think people are stupid. I mean, do people really believe them? Like it's
in the
crazy.
Households are in good shape.
I guess most people do. They listen, right? They take what they're saying as
relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime.
You just said households are in good shape and have manageable levels of debt. It's more debt than households ever had in the history of
So you don't see too much leverage in the banking system or the financial system.
Crazy, man. Maybe his household.
Picture, but it's not an overly troubling picture. And again, I'm not. It's not appropriate. We don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI of the data center story. I think people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about about 25 basis points here or there. We use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here by lowering rates at the margin, that will support demand, and that will support more hiring. And that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, you know, I've told you the story. It's a complicated story, but this is the best assessment that we can make. But you know, because there's uncertainty around inflation and the path ahead for inflation, that's why we're going. That's why the pace we're going has been a careful one.
Victoria. Hi, Victoria Guida from Politico. On AI, I'm just wondering, you know, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different. In the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these are ideas rather than companies. And, you know, so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and, you know, it looks like they have business models and profits. And
They
that
have
kind of
business
thing. So
models.
it's really a different thing. You know,
It's crazy.
The investment we're getting in equipment and all those things that go into creating data centers and feeding the AI, it's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, you know, is much bigger than that, and has been growing, and has defied a lot of, you know, negative forecasts, continuing to do so this year. Consumers are still spending. Now, it may be mostly higher end consumers, or maybe skewed that way, but the consumer is spending, and that's a big chunk of.
It's amazing
of
that
what's
nobody
going on.
ever calls them out. It's like planned, you know. Like, they probably write their own questions.
To growth.
They won't be invited back.
No one ever calls them out.
You maybe growth as opposed
Right.
to level, but consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs.
People don't have
because
money.
There isn't this flow into the
Crazy
pool
stuff.
of labor that, you know, where people need jobs, because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. You know, the economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been
These data centers are destroying property values.
And of course, that will reverse. But
Completely.
you know, you still got the economy growing at a moderate pace.
Andrew.
He keeps saying that. Give an example.
Hey there, Andrew Ackerman with the with the Washington Post. I wanted
Video.
to ask if you could elaborate on how you think about policy in the context of the data
Yeah.
drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. You know, it'll probably be argued both ways, right? But I've said a couple times here that, you know, if you really aren't getting information you really don't know, and the economy looks like it's solid and stable and hasn't really changed, you know, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you know, you slow down when you can't see as far ahead. Others may argue, I mean, I'm not sure where this argument will come, but you're perfectly right that you could also argue, well, things haven't really changed, but you might not know that, you know. So I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting we're getting
They're flying blind.
a better flow of data. But if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a
He's
FinReg
he's
question.
mumbling about
I
stuff.
think
He
several
just-
years ago
you might know,
said
but
the
you don't
overall
know, but you do know if you
capital
know.
system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies, and I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then. through
Yes, I
various
have read this
mechanisms.
book.
But I look forward to I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Brian. Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor
So
market?
we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, then again, we didn't get the September
Yesterday
employment
alone.
report.
Yeah, there were like huge layoff announcements.
We look at,
He needs 2 months to decide if yesterday was
unemployment
bad.
insurance claims, initial claims are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, no story. You can look at the numbers. Same
Crazy,
thing with
man.
the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that
The jobs on Indeed, I'm
or
convinced,
the really
don't
employment
exist.
economy is making a significant deterioration.
Now, listen,
You don't see
I
that.
just put an
You see
ad
more
on
things like
Indeed
I
for
mentioned,
the
though, which is
restaurant.
the,
90% of
you
them
see
just to
big
fill the
companies
application so
making
they can keep their
announcements of
benefits for
either
like SNAP and
layoffs
stuff.
or of
They don't even show up.
the
They just say
idea
they
that
went for a
can-
job.
They don't,
It's
they won't
crazy.
need to hire.
90% of them didn't show
their
up
number
or
of
anything for
employees
interviews.
is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low. And the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular
That we're
section
thinking
of the
of?
labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3
Yet college
years
graduates can't
of
find
that long
jobs.
expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, yeah, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable. Those two things. Inflation also hurts people on fixed incomes more than other people.
Courtney.
Hi, Chair Powell, Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Daniel.
Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is a pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment. And this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both. So we have to balance the two. And so it's a challenging thing. And, as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it. And that's what we have. That makes a lot of sense to me. All of these people are, people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people.
Well,
But
I
they have
guess when the
different views on
economy
what
was
that is.
booming and we had 9% inflation,
It's an honor to work among people
maybe
who
they
care
should have
that
started
much.
raising
It is,
rates a
but
year before they actually
I don't
did.
feel that it's
Perhaps
unfair
maybe in
or
2021.
anything like that. It's a time when we're making quite difficult judgments in real time, and I believe we'll get through this, and I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under, quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last question.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely. I'm curious how the Fed is looking at these loan losses and if it poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously, we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions. But we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending
Middle class pulling
continuing
back
hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there's some relationship there, but remember,
Some.
the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, the stock market, it would affect spending if the stock market went down, but it wouldn't drop sharply unless there were quite a sharp drop in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. But you would see it if you saw a material correction in spending, but it wouldn't be. You shouldn't think that it'll dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
All right, so that wraps that up. Now, what do you think, Amy, of all that? What do you say?
They don't know what they're doing, and they're behind, which is not atypical. I think this is pretty par for the course for their. Can we replace them with AI?
What do you think of AI? Do you think this is just kind of like the beginning where we're seeing job loss, massive job loss?
Yeah, I think it's concerning. One of the reporters actually asked that question, which, as they continue to cut rates, more investment goes into tech, more investments going into these data centers. Does that lead to more job replacement with AI, because that's not going to help the employment rate. So if they're arguing that they're making these cuts to help the labor market, then why, they did cut already in September. Why then in October are we hearing that Amazon's laying off like 30,000 corporate people and UPS is making layoffs? And of course, you could argue that was already kind of in the pipeline and they're just behind on the cuts, which I think that's what Moran is. That's his whole case. He's the dissenter that wanted a 50 basis point cut. And I don't necessarily think that's, I don't think the data that they're saying they're data dependent, the data that they're going off of, in my opinion, is not capturing the reality of what the labor market really is. And if you talk to young people, if you look at that new entrant, to the market, employment rate, it's terrible. So if you already have a job, you're kind of okay. But now even that is not okay, because we're hearing of Amazon and UPS and these big stalwart companies are starting to lay off people. This is not going to be good for consumer confidence. It's not going to be good for the housing market, because if your neighbor loses their job, then you're kind of like, oh, do I want to make this big giant 30-year commitment to purchase some expensive thing? No. But yeah, I think the weirdest thing that I heard in this whole entire thing is that, we don't have data right now because the government shut down. So we're going and we're thinking forward to what might these tariffs do and what might the labor market do in 2 months or whatever. This is exact opposite of how they're supposed to operate, which is data dependent today based on what they have. What is the data today? Does it tell us we should cut, hold, or hike, and make a decision? And it sounds like they don't even know what to do, because like I said, there was dissent in both directions. There was a positive and a negative dissent. So they're a mess.
Yeah, he made it seem like most of the dissent was in the upcoming December meeting as well, which, to your point, if you don't have the data now, how could you argue about what could happen possibly in 2 months from now?
They don't know. They don't have the data now, but
They don't even know what they're doing now.
No, when they had the data.
They have the data from September. Right.
Yeah.
Right. And from September, they keep pushing it back. We don't have the data every time they come out. And they have the data from last time and the time before and the time before, and they just keep passing it along, and nobody is holding them to account. That's the craziest thing. There's no accountability. It's so simple. They have the data. Today's technology, the data is right at your fingertips, pretty much instantly. So they know what they're doing, and they just keep passing it on to the next meeting, the next meeting, the next meeting. Sooner or later, it has to stop, and something has to hold these people accountable. It just blows me away. It's the same conversation every meeting. It's the same questions from the same people that have no idea what they're even asking, because they don't even understand what they're talking about. And the conversations back and forth in that meeting, it's just fluff. There's nothing there. It's the same roundabout conversation with every question asked. It goes back to the same thing. There's never any results pushed out. It's always no ideas. What if this? Oh, will we think this, or we thought that? We were wrong on this. We were wrong on this, but we're okay over here. And then tariffs. that's all you talk about. If the gravitational pull of the moon did this, and this happened here, and this, and then tariffs. That's what they talk. There's nothing to go with reality. It's crazy, and the machine just keeps moving. The economy just keeps moving. Things keep happening, but it's just going in a direction where, listen. Laying off 15,000 people in a day for Amazon, FedEx is coming next, UPS. That's the staples of the economy. People aren't shipping things. People aren't. That's the staples of the economy. And the housing market, forget it. I have a client. I have clients I'm working with right now. One of them's a federal employee. We have to wait until we can't close. We can't do anything. We have to put offers in out an extra amount of time, because they're hoping everything comes back and they get back on track. But it's affecting everything. And in the shutdown of the government, that's another thing they're talking about. There's so much politics, and there's so much pork and fat and all that. They're talking about the SNAP benefits and this thing and that thing. It all relates, and it's all one big, every time you look at one problem, you look at housing, and then you start analyzing it, and then 15 other things pop up. You look at the economy, anything. You look at anything, and 15 more things pop up. It's never just one problem that there's one solution for, because it's all merged together now. It can't end well. That's one thing that I see. You just got to try to position yourself properly in this whole mess. But I don't know. It's just the more and more I listen to these people, the more concerned I get, and the more I realize that we're led by people that don't know what they're doing. So it's kind of crazy.
By the way, everyone, this is Phil Simonetta talking. He's a real estate broker, and then also Amy Nixon popped in. She is a housing market analyst. And Amy, I have a question for you. What was what did you think about when he had said that they would start investing in treasuries? Do you think he's talking about the 10-year treasury to suppress mortgage rates ultimately? I mean, where do you think he was headed with that?
Yeah, I mean, there's been a lot of ultimately kind of on this path to go sort of like the Japan route, which is sort of where, over time, they're trying to control yields without necessarily policy tools. And the Senate has come out and said that they will support the treasury market as needed. Like, they're not going to just let it collapse. Obviously, we've seen, other countries in the last several months are moving their cash reserves more towards buying gold and other assets than they are. U.S. treasuries are kind of falling out of favor. And it's no surprise when you listen to these people that are running the markets, that these are the people, you want to buy treasuries from these people. Like, they don't know what they're doing. Yeah, it kind of gets you to that question, like, are we going to I think, to be honest with you, Ted, we already kind of are tiptoeing down that yield curve control path. And I don't like it, but I think when you've kind of got the economy that we have now and the way that they're operating, and sort of, there's a lot of uncertainty, there's a lot of confusion, even within their own ranks, let alone within the data and in the economy itself. There's going to be a tendency to try to move towards, I think, them trying to control as much as they can and stabilize. They're going to call it things like risk management. I think you use that term, risk management, stabilize, do what they need to do, kind of sort of thing, to keep the whole, Jenga tower from collapsing, basically. And yeah, that'll be interesting to see what they end up doing. It wouldn't surprise me at all if they end up purchasing treasuries and doing, a little bit of yield curve control. And yeah, I'm not really sure what it's going to mean for mortgage rates.
But what do you guys think? Do you guys think it's like a lot of smoke and mirrors, though? I mean, they're just covering up, and it's just like pushing things down the road.
You're saying it won't do anything.
Yeah.
What you're saying, yeah.
Yeah.
It won't fix anything.
Yeah.
They can't.
Right. So it's only going to make things worse, I would think, right? In the long run, it's only going to
long-term,
snowball more, and eventually it has to hit something. So why would they just keep pushing and pushing, and why not just face the facts and start to try to handle it? That's what I don't understand.
What would the facts
is this going to go on forever?
Bill, what do you think the facts would be? I mean, do you think the facts are that we need price, that we actually need deflation?
We need deflation because the market has to correct itself. The more and more, and the more you postpone it, and the more you cover it up, and the more you try to control it, the harder the correction is going to be when it finally happens. And that deflation is going to be catastrophic. It's just going to get worse and worse. What has to be allowed to happen, and they just keep pushing it down the road, and it's only getting worse as it goes.
Yeah, I think their intended. From everything that they've done, it appears that they want to just continue to punt this out and kick the can further down the road. And when you do that, I heard a great quote once that said, when you try to pull risk out of the financial markets, that risk relocates itself in the political arena. And we're already seeing the early, seeds of that now. And I think ultimately, as long as they continue doing what they're doing, we're going to continue to see that wealth gap grow, because that's one of the side effects of the way that they've chosen to handle it. And eventually you're going to get to a point where that bottom 80, 90% start to get very disgruntled. They already are, obviously, and they're getting more and more vocal.
They have enough.
And they're starting to change the way that they vote. They're starting to change the things that they talk about. And I think that there are different ways that it can sort of all hit the fan. at the end of this. And it's not necessarily
Mm-hmm.
going to be a crash and a Great Depression. It could be a political uprising and it's sort of like a revolution.
Could be civil, civil unrest.
Could be civil unrest. It could be, there's people that talk about losing reserve currency status. Everybody was piling into gold and Bitcoin, thinking that these are going to be the new reserve currency assets. The dollar is going to fall. I am not in that camp. I think that as long as we are the most powerful country in the world and we have the government and the military that we have, they will do everything they can to make sure that the dollar does not fall, because that's all they have.
Right.
That's their tools. They even will admit it. These are our two policy tools, but their monetary policy against the dollar. If they lose that, they're nothing. I mean, then we can replace them with ChatGPT.
Got nothing, right?
I think to your
Absolutely
point,
right.
it's so true, because I think that's one of the reasons why they're focusing so much on this AI and us having a lot of that technology here in the U.S., which is why they're really pushing these data centers, because I think the one that holds all of the intel or the data will have certainly an upper hand. I do believe that as well. But what really concerns me, and I don't know where we would head with something like this. It's actually very it should be very disturbing in a lot of ways to young people, because what is happening with this AI breakthrough, and I want to play this clip. Actually, let's play this clip, and then I want to get your opinion on this.
That will be beyond anything we can consider. It's not going to immediately replace pipe
that over
fitters
again,
and
Joe.
plumbers.
Start it over.
It's over. The scale of the political impact of it will be beyond anything we can consider. It's not going to immediately replace pipe fitters and plumbers, but there's a huge block of folks in that soft information economy that are just going to be, it's over.
I just used an LLM. Someone had sent me a contract, 10-page contract. I noticed three things I didn't love in it. It's not only spotted the 3 things I caught, it spotted 3 others. Yep. It then said, would you like me to create a red line version of this contract for you? I said, sure. The contract was done, and guess what? There was no lawyer used.
It's over. The scale of the political
So I mean,
impact.
what is your? We'll start with you, Amy. What do you think? I mean, the AI has the ability to disrupt pretty much everything, and especially when you're talking about attorneys, for instance. I mean, you know, how many years of schooling and hundreds of thousands of dollars. Some of these young people going to universities, even tens of thousands of dollars, are coming out with debt in hope that they can have a career. And look at what he just mentioned, contracts. AI could write you a contract, and certainly we've talked about it with home sales. People say, well, one of the reasons why you can't go around a real estate agent and you would be forced to go to a more potentially expensive route, and that's hiring an attorney, is because I don't have the contracts or the addendums that I need to present an offer. And AI will be able to literally give you these contracts in a matter of seconds. So, Amy, what do you think the disruption is that's coming down the pike with this, the potential for massive scale job loss? I mean, massive scale. Millions and millions of jobs could be cut in the very near future, meaning in the next several years. What is your take on that?
It's really scary for young people. But that being said, I think young people have honestly been through the ringer already, because they've experienced over the last probably decade their jobs being exported or having people imported here to take some of these entry-level jobs, H-1B workers, or their jobs are just going directly overseas. The younger you are, the more that you've already experienced this sort of the disruption that these economic tools can do. And so I think it's going to be really difficult because, like you said, there are a lot of industries that AI can absolutely wipe out or do better at what you're doing. And when you look at it that way, it's almost like, are we going to have to consider like a universal basic income? Or is that what people are going to start voting for? I mean, it's already got Manami in New York, and he's running on, rent freezes, and he's kind of toying with some of these ideas, and he's getting votes. And everybody's like, how in the world, where did this guy come from? But if you start to think about what's happening to the bottom 90%, aka the majority of our country, then it's almost inevitable that this is sort of the way that it's going to turn politically, because people have to live and they have to feel secure that they're going to have a job.
So what are your thoughts?
You saw the perfect example of this yesterday. Yeah, just yesterday, like we were talking about Amazon, 14,000 white collar jobs that they're going into AI, and that's the first one of the first examples. You saw it just happen yesterday.
Yeah,
So
they said maybe 30,000.
I
So
use
there may be
ChatGPT
another-
for things I make.
Yeah.
It works. Yeah, up to 30, right? So there's an example right there. 30,000 jobs wiped out instantly because they're going to advance it into AI. So, and that's white collar jobs. That's not the truck drivers, just like he was saying, not the pipe fitters. It's not the plumbers. It's the white collar jobs. It's the desk jobs. And Amazon just did it. So it's just the start of it. It's going to get a lot worse.
I want to play one more quick clip of what Bill Gates had to say, and this was on CNBC, on TikTok, CNBC, TikTok.
In terms of the jobs, this is going to take some period of time. But yes, although it hasn't been seen in large numbers, over the next several years, there will be some impact on the job market. Nowadays, when you say that, some people are like, oh, how can you say that? Isn't that going to slow the U.S. down in this race? But it's only honest for people to speak frankly about the fact this will have a big effect on the job market. In terms of the jobs,
and we're talking about, when you look at a company like Amazon, I mean, we have seen where I can remember when Walmart was really taking America by storm, and people were saying, well, you have to shop local. The small business is the largest employer in America. And in fact, that's the best avenue for people to go to have the best job opportunities, because you have a business owner, a small business will actually go bankrupt before they let people go, before they lay people off, before they fire people. They'll put their own check. The business owners will put their own check in a drawer to make sure that the employees are paid. And we saw this back in the GFC really show up, where the big corporations, and Starbucks is doing it now. They're closing down locations left and right, 6 of them, I think, just in Baltimore locally alone, in very populated areas, and where you would think that Starbucks would do very well. But they make corporate decisions based on profits and shareholders. That's it. They're only concerned about their stock prices, because that's what are keeping these executives rich. As long as the stocks stay up, that's where their wealth is contained. So their focus obviously is on, we can't have a sell-off. We have to deliver profits. And they do that at the risk of the workforce. And they'll literally just slash a location, get rid of everybody, or they'll tell you have to move your family and kids across the country somewhere, or you don't have a job. And so when Walmart was taking America by storm, I can remember, I mean, I'm old enough to remember when they were starting out and really popping up in all of these communities. And people were almost like ashamed. They were rebelling. They were saying, you know what, I want to shop small business. I'm not going to patronize this big company, but they sell for less. And they're sneaking in the stores with their money in their pockets and buying it like, oh yeah, but I want to feel good, and I want to say this, but I really care about the money that I'm spending, and they can sell it for less. And then we said, who would beat that? Who's the next? Who could actually give Walmart a run for their money? And then this little bookstore, online bookseller, becomes who they are. And now they're such a massive part and, a thread in the community. They're building all of these warehouses. And I remember they built this huge one down in Baltimore to take over the GM plant that sat vacant for years. And, and they brought all of these employees in, and they get all the tax incentives because they're going to create all of these jobs. So then now what? Well, now that they were able to give Walmart a run for the money, put so many small businesses out of business, make it nearly impossible.
Monopolized it.
They've monopolized it, and they can deliver something to you the same day. We're talking about the same company that has a drone air force, the ability to drone products to your front door or a rooftop. I mean,
right.
Now through AI, they're saying, hey, we want to deliver, we need to be more mindful in shaving our losses, and they're at record profits. And here we go. And Amy, I'm afraid what you said with universal basic income, I mean, that's like it. That's like it. When we start getting to the point where people can't find jobs and now all of a sudden, but at the same time, we're seeing all these entitlements getting cut. And there probably was a lot of that was misallocated. I'm certainly not picking on somebody. I think welfare systems are there for a reason, and there are people that need it. But I can remember I interviewed the director of the Baltimore County Housing Choice Voucher Program, which is Section 8. They call it Housing Choice Voucher now. But I remember interviewing her, I think it was probably back in 2018 or 2019. At that point, there was a 25-year backlog that if somebody needed a voucher, a housing voucher, so the pressure was if you have a housing voucher, you're not giving it up. There was no incentive for somebody to dig themselves out of the hole that they were in that caused the reason for the voucher, so they just stayed on it.
The incentive so they stay on it, and then their kids get on it. The incentive is the opposite.
So what?
The whole family's on it, like next generation.
What does universal basic income even mean? What does it look like?
Well, it's not going to be good for the housing market. I can tell you that. Like, who's going to buy houses? If everybody gets, if we have this economy where AI starts taking over the average person's job, then, we have X number of housing units in the country built for people to live in. And you suddenly have a bunch of people don't have jobs, or they're stuck on this stuck income. So there's your rent cap right there, because if their income is capped at this universal amount, then you're only going to be able to charge. They're not going to be able to afford rent increases. And that's not going to make housing like a good investment for investors. But then who's going to buy, all of these $1 million houses that these boomers are sitting on, thinking the world still works the way that it did in the 1980s? Because that's kind of like the mentality that you hear.
Well, how are taxes going to get paid too, right? No
yeah, and how are the taxes are going to get paid? I don't know.
School systems are going to collapse because there's no taxes on property when you can't afford to pay. It's a whole.
The school systems already don't even. The demographics are collapsing.
It's already collapsing
because there's not enough enrollment because nobody's having kids.
Correct. Yep.
Amy, I know what Phil and I both see from boots on the ground, helping people buy and sell houses. But what is your take on buyer sentiments right now? Do you have any signals or any information that you can share? Where do you think a buyer's sentiment is?
It's not strong right now. It's very much the people who are interested in buying right now are kind of aware that, at least especially in the markets where there's a lot of inventory like Dallas, they're in a kind of like the Fed, a wait and see mode. Our price is going to drop a little bit. Our rate's going to come down a little bit. Is the job market going to weaken? Because if yes, they don't want to jump in and buy a house right now. I'm not seeing urgency on people's behalf to move. Like when rates were really low during urgency, you couldn't get a loan officer to return your phone call. There's none of that now. And I actually think as rates are cut by the Fed, like the Fed did actually cut today, small, but they cut. If that brings down mortgage rates, I think we're actually going to see a pickup in refi activity first before we're going to actually see a pickup in buying activity, purchasing applications. And that's because, again, we also just got all this news of Amazon laying off white collar jobs, and the labor market is a very important piece of consumer demand for housing and buying housing. So that is weakening alongside these rate cuts. Then I don't know that they're going to be super impactful, especially because rates are still relatively high and prices are still very high.
Yeah. It certainly doesn't help when the layoffs hit the news, the mainstream. Yeah, it certainly doesn't help the sentiments. And I know I've spoken with a lot of buyers that they are nervous of their own job.
Yep.
And they're seeing layoffs in their own companies. And then again, with everything else being so expensive, the cost of living, Powell talked about the weakening of housing services or the reduction of year-over-year inflation. And by the way, we're talking about disinflation. We're not talking about deflation. So, you know, if prices were allowed to get to a very unaffordable or very concerning rate, then everybody's impacted with that. They see that at the grocery store. They see it at the gas pump. They see, even though fuel's come down, but it's still very expensive. And with fixing their car payments, their repair costs. So that's in their mind as well. Insurance. And when we're seeing that we're not getting actual deflation, but disinflation, it really doesn't solve anything unless salaries go up. And then the flip side of that is employers are also seeing, well, this big company's laying off. Well, this is a fine time for me to start shaving where I might need to as things are slowing down. So I don't really think that the Fed is that in touch with the reality of what's really going on in the street. And you mentioned it, Amy, by saying the unemployment rate of graduates is way higher than the average unemployment rate. And Powell said, well, we don't really get that granular. You know,
they don't go by demographics.
They don't go by demographics.
Consumer spending's good, but 50% of that is the top 10% of the country. So the whole, the other pool is making up for less and less. And honestly, the other piece of that, which again, Paul didn't go into, but if you look anywhere online and look at the charts, all of the bottom 50% consumer spending is increasingly debt, and they're defaulting on it. Like car loans, credit cards, all of that is rising really fast, and there's defaults rising really fast. So that spending is starting to reach its limit in terms of, and especially if these people start to lose their jobs, then they're not going to be able to, they're really going to default on their debt. And shockingly, Todd, I'm seeing foreclosures in our area of DFW for the first time in 3 years. I'm actually seeing auctions on some of these homes. And again, this is insane to me that we basically shut down foreclosures in our country for a 3.5 year period via the CARES Act and all the stuff.
What's going to be interesting too, what's going to be real interesting is seeing Christmas and the holiday shopping, what happens there, where people are tapped out. If that is very low, that's going to throw another whole wrench in. But I don't see how are people going to spend money when they don't have it, and they're tapping out credit wise. But I just want to tell you guys, I got to shoot out. I have a 4:00 appointment. They're just getting here now, so I have to go meet with them. And I was really happy to be here with you guys, and this was fun.
We appreciate you being on, Phil. And actually, we can. Amy, do you have any final thoughts that you want to put out there, and then we can wrap it up? I think it was.
No, I have to head out and pick up kids from school in 5 minutes. So I think it was.
So we're all there.
Yeah.
I don't have anything to do. I'm in the real estate business. I'm in the real estate business. I'm just kind of
now.
That's it. Well, look, I really appreciate both of you. Thanks so much for jumping on, and thanks for everybody watching today. And I think keep those comments coming in. I'd love to know what your opinion is of today's press release. And guys, like I said before, if you haven't subscribed to our channel, please consider doing so now. Do it right now. Why not? Subscribe. Hit that subscribe button. Hit the alert bell. You'll know every time we upload content. And we have great contributors to our channel like the two on the screen right now. Thank you guys so much, and we'll talk to you soon.
Awesome.
Thanks, Todd.
Great being here. See you guys.
Sachs Realty, Maryland broker number 607720, office number 443-318